Good afternoon, ladies and gentlemen. It's a pleasure to be able to present to you today some of the work that I did while I was at the International Renewable Energy Agency and some updated analysis that I've added. My apologies for not being able to do this with you live. I am in Sydney, and with the time difference and the jet lag, I doubt I would be performing at my best. So a recording is I think, in your best interests and mine at this point. For those of you who don't know me, I've spent the last 30 years working on energy modeling and the economics of the energy transition. For the last 12 years, up until July, I was with the International Renewable Energy Agency, leading their work on the costs and performance of renewables, hence the topic of this presentation. I'm now working independently as a consultant and enjoying spending a bit more time with my family. So without further ado, because we have a short time to share some insights, uh, obviously this is not news, but for renewable power generation costs in general, we've seen some quite remarkable cost deflation over the last decade and a half. And you can see here for wind turbine prices, solar PV, and utility scale battery storage, some different metrics. Interestingly, for wind turbine prices, there is now quite a disconnect in the trend between onshore wind turbines and Chinese wind turbine pricing. We saw the spike in polysilicon pricing in 2022 with very tight supply situation as demand took off after the COVID. And similarly with battery storage costs in 2022. But the overall picture obviously is one of, generally speaking, cost declines, and we'll look at that in more detail now for the levelised cost of electricity. And in 2023, it mostly fell for newly commissioned projects, the exceptions being geothermal and bioenergy. For bioenergy, geothermal, hydropower, CSP, and to a lesser extent as well, offshore wind, we see quite a lot of year-to-year volatility based on the amount of new capacity added in different markets and the different cost structures, therefore leading to a different global weighted average. So it's not unusual to see this kind of volatility with bioenergy and geothermal and indeed hydro. Particularly for PV, offshore wind and onshore wind, China's increasing share in 2023 compared to 2022 helped drive down costs. And that has been a recurring theme in many years given their lower cost structures. This chart gives a little bit more detail, looking at the difference between projects commissioned in 2010 and 2023. It's the levelised cost of electricity in real terms, that is to say, allowing or correcting for in general inflation. It excludes all support policies as well, so this is the estimated actual cost. You've got the global weighted average cost, so very significant reductions from solar PV through to onshore wind in the first four columns, and then biomass, geothermal, and hydro. We've seen slightly different dynamics over the time period. The shaded areas are the 5th and 95th percentiles for projects in that year, and the grey bar across the bottom is the fossil fuel cost range. And this is now quite granular data from IRENA on a country level as well. So not quite matching the granularity of the 22,000 projects in the renewable database, but there's a significant number of projects there as well to work on. And the cost reductions you can see here on the right-hand side have been very significant over this period. Offshore wind has been the weakest, but 63% deflation between 2010 and 2023 still is quite remarkable, given what's happened to most of costs in the rest of the economy. That means that today solar and wind offer very competitive electricity, and indeed the global weighted average LCO of offshore wind in 2023 was 25% lower than the weighted average of fossil fuel projects' estimated cost for their lifetime. Again, so some uncertainty obviously about fuel pricing. And that's compared to 2010, which it was 126% higher than fossil fuel price. So, and all of this means that each year what we've seen is a trend towards, particularly from around 2016, a trend to a higher share of newly added capacity being cheaper than the fossil fuel fired cost. Now, this chart's not the global weighted average fossil fuel. This is actually calculated with the individual renewable project against the country level value for the new fossil fuel fire power cost. So it's quite granular. And what we see is this generalized increase above the line, which is to say LCOE of renewables lower than the equivalent fossil fuel cost in that year. And in 2023, virtually all projects at a utility scale added are estimated to have been cheaper than those fossil fuel fired costs. Looking more closely now at offshore wind cost trends after setting that scene, you can see here the trend from left to right in total installed costs, capacity factor, and levelized cost of electricity. Again, global weighted average line, 5th and 95th percentiles for the bars. Some volatility, particularly for total installed costs and capacity factor due to relatively lumpy investments and changes in the shares of deployment in different markets, which may have different cost structures, either within Europe or increasingly with China. Again, as mentioned, 2023, China had a higher share, which helped to drive the reduction in the levelized cost of electricity, predominantly due to their lower total installed costs. Obviously, they have slightly poor wind regimes, so there was a dip in the capacity factor. Cost inflation, as we'll talk about, remains an issue outside of China and is a challenge for projects reaching FID today. But before talking about the cost, just a quick reminder of the global trends in terms of turbine ratings. We're up to around an average of 10 megawatts for 2023 projects, with little difference actually now between Europe and China on this metric. And you can see here the dynamics since 2010, 2017, and 23 for some of the project characteristics. China still has, on average, shallower projects in shallower water and also closer to shore, which obviously helps with cost dynamics. Not only is the hub height now on average higher in China than in Europe for 2023, also rotor diameter, again related no doubt to some of the dynamics around the resource quality compared to Europe. So looking at a little bit more detail in terms of the total installed cost reductions, so you can see from around 2015, we started to see the global weighted average line in black there decline quite significantly. Part of that has been driven by the lower structural costs in China and their increasing share, but you can also see hidden behind that the reduction in total installed costs in Europe as well, as we saw these learning by doing, the increase in economies of scale, and the network benefits of the regional supply chain in Europe, which have been very important at lowering not just total installed costs, but levelized cost of electricity as well. The commodity pricing and generalized cost inflation in 2022 is going to have an impact, but it's going to be, and we'll talk about this in more detail in a minute, it'll be passed through in future projects, essentially. When we look at the levelized cost of electricity here, again, the global weighted average, you can see that actually the importance of the other factors in levelized cost of electricity, so predominantly O&M costs, the technology improvement, so the improvement in capacity factors, means that compared to total install costs, which started to come down significantly in 2015, we've already seen a relatively continuous decline with some bumpiness since 2007. So you can see the importance there of the increase in capacity factors, the benefits of the regional supply chain and economies of scale and the clustering in Europe for O&M. And again, we'll wait to see what the impact of cost inflation is, depending on essentially how important China's deployment is in 2024 and beyond. So focusing in a little bit more on this cost inflation, I think it's important to remember that projects that are commissioned in a given year represent lagging indicators of a range of cost influences. So a commodity price increase will take time to flow through into equipment prices, which in turn takes time to flow through into total project costs in the year of commissioning. So all of this is going to take a little bit of time for offshore wind with the longer project development times to flow through into total installed project costs. But it is going to be significant. And, up till 2021, we saw innovation and market scale learning by doing driving down costs for turbines. But Vestas data since 2021 show a very significant real increase in the order of almost 50% in the space of 2 years. Unfortunately, they're not going to essentially be sharing this data anymore, so it's a bit challenging. We don't know what's happening right now, publicly at least, that we can say. But there are also other factors, obviously, in play in terms of the supply chain, in terms of rapid growth in turbine capacity, which has started to stress supply chains. We'll talk about that in a minute. But again, we're waiting for this impact to flow through into commission projects. Talking of the specific supply chain challenges, Wood Mackenzie data here shows from about 2027 very significant imbalances starting to emerge across different parts of the supply chain. And this is going to have obviously been weighing on projects that are looking at a financial investment decision at the moment. This challenge is partly chicken and egg, but is also related to the constant technology evolution which we're seeing, which is a painful process of scaling up continuously. But industry is working hard to create greater supply chain resiliency and work around this to the extent possible. But given the high ambition, we really need to see an improvement in policy in terms of stable and predictable pipelines. Another important weigher or cost increase has been the cost of capital increase with the inflation that led to central banks raising interest rates, essentially by almost 5% in the space of a very short period of time. We expect them to drop, but it's going to be a slow process, it seems. And this has had a disproportionate effect on the cost of electricity from offshore wind, given the supply, the longer project development timelines. So we're seeing this pass through now in auction prices, for instance. And you can see here, if we use 2022 benchmark total installed costs in blue and the other parameters for that year, we get to around 8 cents for offshore wind. But the full value of the interest rate increase will raise that alone by itself up to around 10.5 cents without some of the other cost pressures that we've seen, for instance, from wind turbine prices. And given the challenging macroeconomic situation, yes, hopefully interest rates will come down, but it's going to be a slow process, and offshore wind is already seeing those cost adders come through, as I said, in those auction prices. So there are a number of headwinds, and some are likely to persist. But it's important to remember that the underlying business case remains strong. Um, Offshore wind in Europe is still competitive. It's cheaper than fossil fuels given the higher average pricing and continuing um, precarity, I would say, of the supply situation for natural gas. But it's very important that we do start to take these supply chain constraints more seriously. A lot of that comes down to policymakers and governments providing a more transparent and stable policy framework with more certainty around the volumes that are going to be coming in over the next 10 years, which would give industry the confidence to invest in new supply chain capacity. And it's urgent. If we're going to triple renewable power generation by 2030, as agreed by most nations at COP28, then, offshore wind is going to play a critical role in Europe's ability to meet that target and provide, high generation over the winter period when demand is also highest in Europe. So it's time to get cracking to realize that potential. So thank you very much for your attention, and it was a pleasure sharing these insights with you.